For most investors, market crashes appear chaotic. Prices fall rapidly. Volatility explodes. Headlines multiply. It feels sudden, unpredictable, irrational. But market breakdowns are not chaotic events. They are mechanical outcomes. They occur when one critical element disappears. Liquidity. Liquidity is not volume. It is not activity. It is not how fast prices move. Liquidity is the ability of a system to absorb stress without disorder. As long as liquidity exists, markets appear stable. As long as liquidity flows, risk can be transferred. As long as liquidity is assumed, prices remain supported. When liquidity disappears, structure fails. And when structure fails, markets reprice. Not gradually, not politely, but structurally. Most participants misunderstand liquidity because they only see its surface. They see tight spreads. They see active trading. They see rising prices. They assume liquidity is abundant, but true liquidity only reveals itself under stress. And late in market cycles, liquidity becomes conditional. It exists only as long as nothing goes wrong. This is the illusion that defines late-stage markets. During stable periods, liquidity feels permanent. Market depth appears endless. Risk feels transferable. Participants stop measuring liquidity. They start assuming it. That assumption is dangerous because liquidity is not a constant. It is behavior dependent. It exists only when participants are willing and able to absorb risk. When incentives change, liquidity vanishes, quietly at first, then all at once. This is why markets rarely break during periods of fear. They break during periods of confidence. Confidence compresses volatility. Compressed volatility encourages leverage. Leverage increases dependency on liquidity. The system becomes efficient, but efficiency without redundancy is fragile. Liquidity is the redundancy. And late in cycles, redundancy is optimized away. Market makers reduce inventory, balance. Sheets are constrained. Risk limits tighten. Liquidity provision becomes algorithmic. Algorithms supply liquidity when volatility is low. They withdraw liquidity when volatility rises. This is not a flaw. It is how they are designed. But when many systems behave this way simultaneously, the system becomes brittle. Late cycle markets rely heavily on this conditional liquidity. They function smoothly until volatility rises slightly above expectations. At that point, liquidity does not decline gradually. It disappears. This is why late cycle corrections feel sudden, not because information arrived suddenly, but because liquidity left suddenly. Before major market declines, prices often remain stable. Indexes hover near highs. Volatility remains subdued. Confidence persists. Underneath, liquidity is already thinning. Depth declines during stress events. Spreads widen briefly, then normalize. Funding becomes more selective. These signals are subtle. They do not trigger panic. They do not dominate headlines, but they matter. They indicate that liquidity is becoming fragile. Late in cycles, liquidity becomes concentrated. Fewer participants provide it. Fewer strategies dominate flows. Fewer balance sheets absorb risk. This concentration increases efficiency. It reduces resilience. When liquidity is concentrated, its withdrawal has outsized impact. And withdrawal does not require panic. It requires constraint. Constraints emerge quietly. Risk managers reduce exposure. Funding desks tighten terms. Market makers lower size. Each decision is rational in isolation. Collectively, they remove liquidity from the system. This process is invisible to most participants. Prices may continue rising during this phase because late cycle markets are driven by positioning, not depth. Capital flows into what has worked. Strategies crowd into the same exposures. Correlation increases. This creates the illusion of strength. In reality, it creates fragility. The system appears robust because nothing has tested it recently. Liquidity has not been challenged. Late cycle markets are untested systems. They perform well under expected conditions. They fail under deviation. Liquidity is the mechanism that determines how deviation is absorbed. When liquidity is deep, shocks are dampened. When liquidity is thin, shocks propagate. This is not psychological. It is structural. Liquidity determines whether price movement reflects information or constraint. In early cycles, price moves reflect information. In late cycles, price moves increasingly reflect liquidity conditions. This distinction matters. When liquidity drives price, fundamentals become secondary. Prices move because they must. This is why late cycle declines often ignore valuation. They are not about value. They are about flow. Liquidity shortages force selling. Forced selling does not care about price. It cares about survival. This is the most dangerous phase of a market cycle. Not when fear dominates, but when liquidity quietly retreats. By the time fear appears, liquidity has already left. This is why interventions often arrive too late. Policy responds to visible stress. Liquidity disappears before stress becomes visible. Late cycle markets therefore exhibit a specific pattern: calm price action, low volatility, increasing leverage, shrinking liquidity buffers. This combination is unstable. It does not announce itself. It feels normal. Most participants confuse calm with safety. They believe that low volatility means low risk. In reality, low volatility often signals concentrated risk. When volatility is suppressed, risk accumulates. Liquidity becomes the only shock absorber. Once liquidity fails, volatility explodes. This is why volatility spikes are not causes. They are consequences. Liquidity disappears first. Volatility follows. Understanding this sequence is critical. Markets do not break because volatility rises. Volatility rises because liquidity breaks. Late cycle markets price stability aggressively. They assume liquidity will remain available. They assume exits will be orderly. They assume corrections will be shallow. These assumptions hold only as long as liquidity exists. When liquidity is conditional, assumptions fail. The system transitions from absorption to amplification. Small shocks become large moves. Local stress becomes systemic pressure. This is how liquidity-driven breakdowns occur, not through emotion, through mechanics. Every major financial crisis followed this pattern. Liquidity deteriorated quietly, depth declined incrementally, funding tightened at the margins. Prices remained supported until they weren't. When liquidity finally failed, repricing was rapid. The timing differed, the triggers differed, the structure was the same. Late cycle markets are vulnerable because they rely on continuous liquidity. They assume that risk can always be transferred. They assume that funding will always roll. They assume that balance sheets will expand when needed. These assumptions are not guaranteed. When any of them fail, liquidity disappears. And when liquidity disappears, the system breaks. Not emotionally, structurally. Liquidity does not disappear randomly. It disappears because of leverage. Leverage is the force that transforms normal market movement into systemic stress. In stable environments, leverage feels harmless. It increases efficiency. It improves returns. It smooths outcomes. But leverage does something critical. It removes tolerance. When leverage is low, markets can absorb price movement. When leverage is high, even small moves matter. Late in market cycles, leverage is rarely obvious. It is not always visible on balance sheets. It does not always appear in traditional ratios. Modern leverage hides. It hides in derivatives. It hides in structured products. It hides in volatility targeting strategies. It hides in off-balance sheet exposures. This makes the system appear safer than it is. Participants believe leverage is controlled. In reality, leverage has simply shifted form. Derivatives allow exposure without ownership. Options compress risk into convex structures. Futures amplify directional bets with minimal capital. These instruments are efficient. They are also unforgiving. When markets move against leveraged positions, adjustment is mandatory. Margins increase. Collateral requirements rise. Funding becomes selective. Positions must be reduced. This is not discretionary, it is mechanical, and mechanical behavior is synchronized. Many participants use similar models. Many rely on similar signals. Many respond to the same thresholds. When volatility rises slightly, leverage constraints activate. Risk models delever. Exposure is reduced. Positions are unwound. This selling is not driven by fear. It is driven by rules. Rules do not hesitate. They execute. This is why liquidity disappears rapidly. As leverage positions unwind, selling pressure increases. Selling pressure pushes prices lower. Lower prices increase volatility. Higher volatility tightens risk constraints. This creates a feedback loop. Liquidity disappears, not because participants choose to withdraw. It disappears because they are forced to. Late cycle markets are particularly vulnerable to this dynamic because leverage is normalized. Strategies are built around it. Returns depend on it. Risk models assume its availability. When leverage becomes unstable, the system must adjust. Adjustment is not smooth. It cascades. Another critical mechanism is margin sensitivity. Margin requirements are designed to protect lenders. They increase when volatility rises. This is rational. But margin systems are procyclical. They tighten precisely when markets are under stress. As prices decline, margins increase. As margins increase, capital is required. When capital is unavailable, positions are liquidated. This liquidation is automatic. It does not wait for analysis. It does not consider valuation. It responds to arithmetic. This is how liquidity evaporates. Markets do not run out of buyers. They run out of balance sheet capacity. Late in cycles, balance sheet capacity is limited. Banks operate under tighter regulations. Market makers hold less inventory. Capital requirements constrain expansion. This reduces the system's ability to absorb shocks. In previous decades, market makers absorbed volatility. They held inventory. They provided continuity. They smoothed transitions. Modern market making is different. It is risk neutral. It is hedged continuously. It minimizes exposure. This model functions well in stable environments. It withdraws under stress. When volatility rises, hedging costs increase. When hedging costs increase, liquidity provision declines. Market makers step back. This is not a failure. It is design. But when many market makers step back simultaneously, liquidity collapses. Late cycle markets underestimate this. They assume liquidity will persist because it has persisted recently. But persistence is conditional. Another critical factor is funding structure. Modern markets rely heavily on short-term funding. Positions are not financed permanently. They are rolled. As long as funding markets function smoothly, this is invisible. When funding tightens, it becomes decisive. Funding tightens quietly. Haircuts increase. Terms shorten. Counterparty scrutiny rises. This does not make headlines, but it changes behavior. Participants reduce exposure proactively. Liquidity provision declines. This happens before prices react. By the time prices move, funding conditions have already deteriorated. This sequence is important. Liquidity disappears before price dislocation becomes visible. This is why market stress often feels sudden. Participants assume liquidity until it is gone. Another mechanism that accelerates liquidity loss is correlation. During stable periods, assets appear diversified, equities behave independently, sectors rotate, strategies produce uncorrelated returns. This independence depends on liquidity. When liquidity contracts, correlations rise. Participants sell what they can, not what they want. Liquid assets move first, illiquid assets follow. Correlation spreads, diversification fails. This failure is structural. Late cycle markets underestimate correlation risk. They assume diversification will protect portfolios. Diversification requires liquidity. Without liquidity, diversification collapses. This increases selling pressure, which further reduces liquidity. Another reinforcing mechanism is passive flows. Passive investing allocates capital mechanically. When prices rise, capital flows in. When prices fall, capital flows out. During stable periods, this compresses volatility. It creates smooth price action. But passive flows do not provide discretionary liquidity. They do not step in during stress. They respond after prices move. This makes them amplifiers. Late cycle markets are heavily influenced by passive flows. Capital is concentrated in the same assets, the same indexes, the same factors. When momentum reverses, flows reverse. This accelerates liquidity loss, not because of fear, because of rules. Another structural factor is volatility targeting. Many strategies adjust exposure based on volatility. When volatility is low, exposure increases. When volatility rises, exposure decreases. This creates a procyclical effect. During calm periods, exposure builds. During stress, exposure is reduced. This reduction adds selling pressure, which increases volatility, which forces further reduction. This loop accelerates liquidity withdrawal. Late cycle markets are saturated with volatility-sensitive strategies. This increases fragility. Small volatility changes trigger large flows. Liquidity disappears rapidly. Another underappreciated factor is the illusion of market depth. Order books appear full during calm periods. Spreads are tight. Trades execute easily. This creates confidence. But much of this depth is artificial. It is provided by algorithms. It disappears when conditions change. When volatility spikes, algorithms widen spreads. They reduce size. They withdraw. Depth collapses. This collapse happens faster than humans can react. By the time participants notice, liquidity is already gone. Late cycle markets often mistake activity for depth. They assume that because markets are active, liquidity is deep. This is false. Activity can exist without resilience. Resilience requires willingness to absorb loss. Late cycle markets lack this willingness because risk is concentrated. Another mechanism accelerating liquidity loss is mark-to-market accounting. As prices decline, losses are realized. As losses are realized, capital shrinks. As capital shrinks, risk capacity declines. This forces further selling. This process is mechanical. It does not wait for recovery. Late cycle markets underestimate this effect. They assume fundamentals will stabilize prices. But during liquidity-driven adjustments, fundamentals are irrelevant. Prices move because balance sheets must adjust. This is why strong assets decline during crises. Not because they are weak, because they are liquid. Liquidity becomes a liability. Assets that can be sold are sold. This increases correlation, which further reduces liquidity. Another overlooked mechanism is expectation compression. Late cycle markets operate within narrow expectation ranges. Participants expect continuity. They expect mean reversion. They expect intervention. These expectations suppress volatility. They also reduce preparedness. When outcomes fall outside expectations, adjustment is violent. Liquidity disappears because participants are positioned for stability. Positions must be unwound. Unwinding removes liquidity. Another critical factor is the erosion of discretionary decision-making. Modern markets rely on systems, algorithms, rules-based strategies, automated risk controls. These systems respond instantly. They do not assess context. They execute. This speed removes friction. Friction dampens extremes. Without friction, liquidity evaporates faster. Late cycle markets underestimate this acceleration. They assume adjustment will be gradual. Structure ensures it will not. Liquidity-driven breakdowns therefore share common characteristics. They feel sudden. They feel disproportionate. They feel irrational. In reality, they are predictable outcomes of structure. Liquidity disappears because leverage forces it to, because funding tightens, because balance sheets contract, because systems respond simultaneously. This is why policy responses often struggle. Policy operates on human timeframes. Markets operate on machine timeframes. Liquidity disappears before policy can react. By the time intervention arrives, damage is done. This does not mean intervention is useless. It means it is delayed. Late cycle markets therefore exhibit asymmetric behavior. Upside is gradual. Downside is abrupt. This asymmetry is structural. It is driven by liquidity dynamics. Understanding this reframes market risk. Risk is not volatility. Risk is dependency. Dependency on liquidity. Late cycle markets are highly dependent. They require continuous liquidity to function. When liquidity becomes conditional, risk increases dramatically. This is why liquidity matters more than narrative, more than valuation, more than sentiment. Liquidity determines outcomes. When liquidity is abundant, markets absorb shocks. When liquidity disappears, markets amplify them. This is the transition that defines late cycle breakdowns. Not panic, constraint, not emotion, mechanics. Policy intervention is designed to stabilize markets, but late in cycles, intervention often does the opposite. It increases fragility instead of reducing it. This is not because policymakers act irrationally. It is because the structure of markets has changed. When interventions worked effectively in the past, markets were different. Leverage was lower, liquidity providers held inventory, participation was more discretionary, intervention addressed temporary dislocations. Today, intervention interacts with a tightly coupled system. In tightly coupled systems, external force amplifies internal stress. This is the core problem. Policy responses assume elasticity. Markets now behave rigidly. When central banks inject liquidity, they expect transmission. Lower rates should ease funding. Asset purchases should stabilize prices. Confidence should return. Late cycle markets respond differently. Liquidity does not flow evenly. It concentrates. It flows into the most liquid instruments, into the most crowded trades, into the same assets already carrying excess exposure. This increases imbalance. Instead of restoring resilience, intervention reinforces concentration. This is why policy often appears effective initially. Prices stabilize briefly. Spreads tighten temporarily. Volatility declines. But beneath the surface, fragility increases. Participants interpret intervention as confirmation. Confirmation that downside is limited. Confirmation that risk is protected. Confirmation that exposure remains justified. This interpretation changes behavior. Leverage is maintained. Hedges are reduced. Risk is reintroduced. Intervention delays adjustment. Delayed adjustment accumulates pressure. When adjustment finally occurs, it is larger. This is not hypothetical. It is observable across cycles. Another structural issue is policy timing. Policy responds to visible stress. Liquidity stress develops invisibly. By the time stress appears in prices, liquidity has already thinned. Intervention arrives late. It stabilizes prices temporarily, but it does not restore depth. Depth requires willingness to absorb loss. Policy cannot create that willingness. It can provide liquidity. It cannot force balance sheets to expand. In modern markets, balance sheets are constrained. Regulation limits risk-taking. Capital requirements restrict expansion. Political pressure discourages losses. Liquidity provision becomes conditional. Policy cannot override these constraints. Another problem is signaling. Policy intervention signals concern. Concern alters behavior. Participants reassess risk models. They tighten limits. They reduce exposure. This happens even as liquidity is injected. The signal contradicts the action. Liquidity is added. Confidence declines. This paradox undermines effectiveness. Late cycle markets are highly sensitive to signals. Small policy shifts trigger large reactions because expectations are narrow. When policy deviates from expectation, uncertainty spikes. Uncertainty reduces liquidity. Another structural conflict lies in inflation. When inflation is low, policy has freedom. Intervention carries minimal cost. When inflation is elevated, policy is constrained. Liquidity injection risks reigniting inflation. Markets understand this. They know intervention has limits. This knowledge changes response. Participants do not assume unlimited support. They assume conditional support. Conditional support is unstable. It creates hesitation. Hesitation reduces liquidity. This is why modern intervention often calms prices, but not structure. Prices may stabilize. Liquidity does not return. Depth remains thin. Another factor is policy fatigue. After years of intervention, markets adapt. Intervention becomes expected. Expected support is priced in. When support is delivered, it no longer surprises. It does not restore confidence. It simply maintains baseline. This reduces marginal effectiveness. Each intervention does less, but creates more distortion. This is diminishing returns. Late cycle markets are dominated by diminishing returns. Another problem is cross-market transmission. Policy interventions are rarely isolated. Lower rates affect currencies. Asset purchases affect term premiums. Liquidity provision affects global flows. These spillovers create instability elsewhere. Emerging markets experience capital volatility. Currencies adjust abruptly. Funding conditions tighten unevenly. This feeds back into core markets. Intervention stabilizes one area while destabilizing another. This complexity reduces control. Policymakers manage one dimension. Markets respond across many. This mismatch amplifies fragility. Another structural limitation is speed. Policy operates slowly. Markets operate instantly. By the time policy is announced, markets have already adjusted. Algorithms front-run expected actions. Liquidity is withdrawn preemptively. Intervention arrives into a thinner market. This reduces effectiveness. It also increases volatility. Because actions are anticipated and crowded, another issue is credibility. Policy credibility depends on consistency. Late cycle environments force inconsistency. Inflation requires tightening. Financial stress requires easing. Policy alternates. This confuses expectations. Confused expectations reduce liquidity. Participants hesitate. They reduce exposure. Liquidity thins. Another underappreciated factor is moral hazard saturation. After repeated interventions, moral hazard becomes embedded. Risk-taking is normalized. Participants assume protection as default. This reduces resilience. When intervention fails to fully stabilize markets, confidence collapses. The gap between expectation and reality widens. This gap accelerates adjustment. Another critical mechanism is policy-induced volatility compression. Prolonged intervention suppresses volatility. Low volatility encourages leverage. Leverage increases sensitivity. When volatility returns, leverage unwinds violently. Intervention, therefore, plants the seeds of future instability. This does not mean intervention is wrong. It means intervention changes system dynamics. Late cycle markets are products of past policy. They reflect years of accommodation. Removing accommodation is destabilizing. Maintaining accommodation is inflationary. Policy is trapped. Markets sense this trap. This awareness alters behavior. Participants no longer trust policy to resolve outcomes. They position defensively. Defensive positioning reduces liquidity. This happens even in calm periods. Another structural issue is the misalignment between policy objectives and market mechanics. Policy aims to stabilize prices. Markets require liquidity. Stabilizing prices without restoring liquidity creates fragility. Prices appear stable. Structure is weak. This is dangerous. It creates false confidence. Participants increase exposure. When liquidity fails, adjustment is severe. Another limitation is policy targeting. Policy tools are blunt. They affect entire systems. Stress is localized. Intervention overshoots. Some areas overheat. Others remain constrained. This uneven response creates imbalances. Imbalances reduce resilience. Another factor is expectation anchoring. Markets anchor to previous policy responses. They expect repetition. When policy deviates, surprise increases volatility. Surprise reduces liquidity. Late cycle markets are especially sensitive to deviation because assumptions are deeply embedded. Another issue is political constraint. Policy decisions are scrutinized. Bold action becomes risky. Delayed action becomes common. Delay worsens outcomes. Markets adjust before policy acts. Liquidity disappears first. Another overlooked dynamic is coordination failure. Global policy coordination has weakened. Different regions face different constraints. Actions diverge. This creates volatility. Capital moves rapidly. Liquidity fragments. Fragmented liquidity is fragile. Another structural reality is that policy cannot force risk absorption. Liquidity requires risk-taking. Risk-taking requires confidence. Confidence requires clarity. Late cycle environments lack clarity. Intervention increases uncertainty because it signals constraint. Markets respond by reducing risk. Liquidity contracts. This is why late cycle interventions often fail to prevent instability. They address symptoms. They do not repair structure. Structure was shaped over years. It cannot be repaired quickly. Another problem is policy dependency. Markets have become dependent on intervention. Dependency reduces resilience. When intervention is constrained, markets struggle. This struggle manifests as volatility. Volatility further constrains policy. This feedback loop is destabilizing. Late cycle markets are caught in this loop. Another factor is narrative conflict. Policy communicates reassurance. Markets observe constraint. This mismatch undermines confidence. Confidence is critical for liquidity. Without confidence, liquidity evaporates. Another reason intervention amplifies instability is that it delays necessary adjustment. Markets need to reprice. Intervention postpones repricing. Postponed repricing accumulates pressure. When repricing occurs, it is abrupt. This is why late cycle corrections feel violent, not because intervention caused collapse, but because it delayed adjustment. Understanding this changes how policy should be interpreted. Intervention is not a guarantee. It is a signal of constraint. Late cycle markets respond accordingly. They become more sensitive, more reactive, more fragile. This is not pessimism, it is structural realism. Policy responses that worked before now interact with a different system, a faster system, a more leveraged system, a more constrained system. Outcomes change, not because intent changes, but because structure does. Market breakdowns are often described as reactions: a reaction to news, a reaction to events, a reaction to shocks. This framing is misleading. Late cycle markets rarely fail because of a single trigger. They fail because structure no longer supports normal functioning. The trigger is incidental. The breakdown is structural. This is why many market dislocations appear to come from nowhere. No major headline, no obvious catalyst, no clear cause. Prices move abruptly. Liquidity vanishes. Volatility spikes. Observers search for explanations. They point to news that occurred hours earlier. They identify narratives after the fact. But the real cause was already present. It was embedded in structure. Late cycle systems accumulate fragility quietly. They function normally until they do not. This is the defining characteristic of tightly coupled systems. They absorb small stresses without visible impact. They appear stable, but once a threshold is crossed, adjustment is rapid. There is no gradual transition. There is no warning, because the warning existed long before price reacted. The most common misconception is that volatility causes fragility. In reality, fragility causes volatility. Volatility is a symptom. Fragility is the condition. Late in cycles, fragility increases even as volatility declines. This creates a dangerous illusion. Low volatility signals safety. Stable prices signal resilience. Tight spreads signal liquidity. These signals are backward-looking. They describe recent conditions. They say nothing about capacity. Capacity is forward-looking. It determines how the system behaves under stress. Late cycle markets lose capacity, not because participants are reckless, but because incentives reward optimization. Optimization removes slack. Slack is redundancy. Redundancy is resilience. As systems optimize, redundancy disappears. Liquidity providers reduce inventory. Balance sheets are minimized. Risk is hedged dynamically. This works in stable conditions. It fails under stress. When stress arrives, there is no buffer, no excess capacity, no one willing to absorb imbalance. Prices must adjust. Adjustment is abrupt. Another misconception is that markets fail because participants panic. Panic is rare. Most modern dislocations are mechanical. They are driven by rules. Risk limits are breached. Volatility thresholds are crossed. Margin requirements increase. These responses are automatic. They do not require emotion. They require arithmetic. This is why late cycle breakdowns feel sudden, not because behavior changed suddenly, but because rules activated simultaneously. Many participants use similar frameworks, similar risk models, similar volatility targets, similar leverage constraints. During calm periods, these similarities are invisible. During stress, they synchronize behavior. Synchronization removes offsetting flows. Instead of buyers and sellers balancing, everyone adjusts in the same direction. Liquidity disappears. Another reason breakdowns appear unprovoked is that stress accumulates invisibly. Funding conditions tighten at the margins. Liquidity depth declines gradually. Positioning becomes crowded. None of this moves prices immediately. Markets continue to function, but tolerance shrinks. The margin for error narrows. When a small disturbance occurs, it exceeds tolerance. Adjustment follows. The disturbance did not cause fragility. It revealed it. Late cycle systems are sensitive. Sensitivity is not weakness. It is a property of structure. Highly efficient systems are sensitive. They perform well under expected conditions. They struggle under deviation. Late cycle markets are highly efficient. They are optimized for stability. That optimization removes resilience. This is the paradox. The better markets function during calm periods. The worse they behave under stress. Another important factor is liquidity illusion. Liquidity is often confused with activity. High trading volume is seen as liquidity. Narrow spreads are seen as liquidity. Price movement is seen as liquidity. These are proxies. They are not liquidity itself. True liquidity is the ability to transact without moving price. That ability depends on balance sheet willingness. In late cycle markets, willingness is conditional. Liquidity exists only under specific assumptions: low volatility, predictable flows, stable funding. When these assumptions fail, liquidity is withdrawn. This withdrawal is rational. It protects capital, but it accelerates price movement. This is why liquidity disappears precisely when it is needed. Another structural vulnerability lies in the dominance of systematic strategies. Many strategies respond to signals rather than judgment, momentum, volatility targeting. Risk parity, trend following. These strategies perform well in stable environments. They reduce volatility. They smooth returns. But they share similar triggers. When volatility rises, exposure is reduced. When momentum reverses, positions are unwound. When correlations shift, allocations change. These adjustments happen quickly. They are rule-based. They are synchronized. Late cycle markets contain large volumes of systematic exposure. This increases fragility, not because strategies are flawed, but because their interaction amplifies movement. Another factor is the erosion of discretionary liquidity. In previous cycles, human market makers absorbed shocks. They held inventory. They took risk. They negotiated. Today, much of that discretion is gone. Market making is capital efficient. Inventory is minimized. Risk is hedged instantly. This reduces friction. Friction dampens extremes. Without friction, adjustment accelerates. Late cycle markets underestimate the value of friction. They price efficiency. They ignore resilience. Another reason breakdowns feel sudden is that markets confuse solvency with stability. Solvent systems can still experience violent dislocations. Liquidity, not solvency, determines short-term behavior. Late cycle markets focus on fundamentals, earnings, balance sheets, valuations. These matter over time. They do not prevent short-term instability. Liquidity overrides fundamentals during stress. This is why assets with strong fundamentals can sell off sharply. The system needs liquidity. It sells what it can. Another structural issue is funding dependence. Modern markets rely heavily on short-term funding. Positions are rolled continuously. As long as funding is available, this is invisible. When funding tightens, positions must adjust. This adjustment is immediate. Late cycle markets often price assets, assuming funding continuity. When funding conditions shift, repricing is mechanical. Another underappreciated dynamic is collateral sensitivity. Collateral values underpin leverage. When prices rise, collateral expands. When prices fall, collateral contracts. This feedback loop is powerful. Late cycle markets often ignore it. They focus on price levels. They ignore collateral dynamics. When prices decline modestly, collateral reduction forces selling. Selling pushes prices lower. This accelerates adjustment. Another contributor to silent breakdowns is correlation instability. During calm periods, correlations appear low. Assets seem diversified. This diversification is liquidity dependent. When liquidity contracts, correlations rise. This is structural. Participants sell what they can, not what they want. Assets move together. Diversification fails. Late cycle markets often underestimate correlation risk. They assume diversification will protect. When it fails, adjustment is rapid. Another reason breakdowns appear unprovoked is that market participants rely on recent experience. Recent experience conditions expectations. If markets have absorbed shocks repeatedly, confidence increases. Participants extrapolate. They assume continuity. This reduces hedging. This increases exposure. When the environment changes, positioning is vulnerable. Adjustment is sudden. Another factor is expectation compression. Late cycle markets operate within narrow expectation ranges. Participants agree on likely outcomes. This reduces uncertainty. It also reduces preparedness. When outcomes fall outside the narrow range, repricing is sharp. Another structural vulnerability is the suppression of volatility. Volatility suppression encourages leverage. Leverage increases sensitivity. When volatility rises, leverage unwinds. This is nonlinear. Small volatility increases trigger large position changes. Late cycle markets often price volatility as persistently low. When volatility rises even modestly, response is disproportionate. Another reason breakdowns feel sudden is that stress propagates faster than interpretation. Markets move at machine speed. Understanding moves at human speed. By the time narratives emerge, adjustment is already underway. This creates the illusion of surprise. In reality, structure was dictating outcomes. Another overlooked factor is regulatory synchronization. Regulations require similar behavior across institutions. Capital requirements, risk limits, stress tests. During stress, institutions respond similarly. They reduce risk. This removes liquidity. Systemic stability declines. Late cycle markets often assume institutions will stabilize markets. In reality, institutions must protect themselves first. Another vulnerability is performance pressure. Managers are evaluated relative to benchmarks. Deviation is costly. This encourages consensus positioning. Consensus reduces resilience. When consensus unwinds, adjustment is violent. Another reason breakdowns occur without warning is that warning signs are subtle. They appear as minor anomalies, slightly wider spreads, localized funding stress, small volatility spikes. These are easy to ignore. They conflict with narratives of stability. Acting on them early is costly, so they are dismissed until they are no longer ignorable. By then, adjustment is underway. Another structural issue is the belief in control. Markets often assume risks can be managed. That policy will intervene. That liquidity will appear. Late cycle environments challenge this belief. Constraints limit intervention. Liquidity is conditional. When control is questioned, confidence erodes. Confidence loss accelerates adjustment. Another factor is feedback amplification. Small price moves trigger risk reduction. Risk reduction causes price moves. This feedback loop accelerates. Late cycle markets are prone to this because leverage and sensitivity are high. Another reason breakdowns feel sudden is that markets mistake calm for stability. Calm reduces emotional response. It does not guarantee capacity. Capacity depends on structure. Late cycle markets often lack capacity. They function until stressed, then adjustment is abrupt. Understanding this reframes how breakdowns should be interpreted. They are not failures. They are corrections of misalignment. Alignment between price and structure is restored through repricing. Repricing is rarely smooth because structure changes slowly. Price adjusts quickly. This mismatch creates sudden movement. Late cycle breakdowns are therefore not surprises. they are delayed consequences. Consequences of prolonged optimization, consequences of suppressed volatility, consequences of concentrated risk, consequences of conditional liquidity. They occur without a single cause, because the cause is cumulative. Structure reaches its limit and adjusts, quietly at first, then rapidly. This is how late cycle markets break, not with noise, but with silence, until movement makes the silence visible. After a late cycle breakdown, markets do not immediately stabilize. They adapt. Adaptation is not recovery. It is not a return to previous conditions. It is a reconfiguration of behavior, incentives, and structure. This distinction matters because many observers mistake adaptation for weakness. They look at post-adjustment markets and see lower returns, lower volatility, adjusted performance, reduced liquidity, slower growth. They conclude something is broken. In reality, something has changed. The system has shifted into a new equilibrium, one that reflects constraints that were previously ignored. Post-breakdown environments are often described as boring. Price action is choppy. Trends are weaker. Rallies fade. Drawdowns are contained but frequent. This boredom is not accidental. It is the result of reduced leverage, reduced sensitivity, reduced expectation compression. In other words, it is the result of realism returning. Before breakdowns, markets price continuity. After breakdowns, they price uncertainty. This changes everything. Participants become more selective. Risk management tightens. Liquidity provision becomes conditional again. Not optimistic, not pessimistic, just cautious. This shift reduces fragility, but it also reduces upside. That trade-off defines post-cycle environments. One of the first changes after a breakdown is behavior around leverage. Leverage does not disappear, but it becomes expensive. Funding terms tighten, haircuts increase, margin requirements rise. This forces participants to carry less exposure. Less exposure means less amplification. Less amplification means less extreme outcomes, both up and down. This is why post-breakdown markets often feel range-bound. They lack the fuel for sustained trends. Another major shift is in liquidity provision. Liquidity providers become selective. They widen spreads. They reduce size. They demand compensation for risk. This reduces apparent liquidity, but it improves resilience because liquidity is no longer assumed. It is earned. This discourages overextension. Another important adaptation occurs in expectations. Before breakdowns, expectations are narrow. After breakdowns, they widen. Participants become aware of tail risk. They remember that stability is conditional. This memory affects pricing. Risk premia expand. Volatility is repriced higher. Insurance becomes expensive. This discourages excessive risk-taking. The system becomes less sensitive. Another shift occurs in correlation behavior. Before breakdowns, correlations appear low. After breakdowns, participants assume correlations can rise. This changes portfolio construction. Diversification is treated cautiously. Liquidity stress is considered. Scenario analysis becomes more conservative. This reduces shock transmission. Another adaptation is the return of discretion. Rules dominated. Late cycle markets. After breakdowns, judgment returns. Participants override models. They reduce exposure manually. They slow down. This reintroduces friction. Friction reduces efficiency, but it increases stability. Another change occurs in narrative dominance. Before breakdowns, narratives are strong. They justify exposure. They suppress doubt. After breakdowns, narratives weaken. Confidence declines. Certainty erodes. Participants stop extrapolating. This reduces herd behavior. Herd behavior amplifies cycles. Its reduction stabilizes markets. Another important adaptation is time horizon extension. Late cycle markets are short-term focused. After breakdowns, horizons lengthen. Participants demand margin of safety. They require compensation for uncertainty. They accept lower returns in exchange for resilience. This changes capital allocation. Speculative capital retreats. Long-term capital becomes dominant. This shifts market character. Another adaptation occurs in policy perception. Before breakdowns, policy is assumed effective. After breakdowns, policy is seen as constrained. This changes expectations. Markets stop pricing immediate intervention. They price delays. They price trade-offs. This reduces moral hazard. Another shift is in volatility behavior. Volatility no longer collapses to extremes. It oscillates within higher ranges. This discourages leverage. It rewards risk management. Participants adapt. Another important change is the redistribution of risk. Before breakdowns, risk is concentrated. After breakdowns, it disperses. Positions are reduced. Strategies diversify. Exposure spreads. This improves resilience. Another adaptation occurs in market leadership. Late cycle markets are dominated by narrow leadership. After breakdowns, leadership rotates. No single asset dominates. No single theme controls returns. This reduces systemic risk. Another structural change is the rebuilding of buffers. Capital buffers increase. Liquidity buffers grow. Risk limits tighten. This reduces sensitivity. Another important shift is learning. Breakdowns teach participants where assumptions failed. They learn that liquidity is conditional. They learn that diversification is fragile. They learn that leverage amplifies pain. This learning changes behavior, not permanently, but long enough to matter. Another adaptation is regulatory response. Regulators tighten standards. They increase oversight. They reduce flexibility. This reduces risk-taking. It also reduces growth. Again, the trade-off. Another change occurs in sentiment. Sentiment becomes cautious. Optimism is tempered. Fear is remembered. This reduces extremes. Another adaptation is the repricing of time. Future growth is discounted more heavily. Certainty is valued. Speculation is penalized. This changes valuation frameworks. Another shift occurs in participation. Retail activity often declines. Institutional activity becomes dominant. This stabilizes flows. Another important change is structural memory. Markets remember breakdowns. That memory fades over time, but it shapes the next cycle. Post-breakdown environments are therefore transitional. They are not permanent. They last until confidence rebuilds, until volatility compresses, until leverage returns. This is how cycles restart. But the immediate post-breakdown phase is distinct. It is characterized by realism. Realism about limits. Realism about uncertainty. Realism about risk. This realism is often misinterpreted as stagnation. But stagnation is not the same as stability. Stability after breakdowns is earned. It reflects structure aligning with pricing. Late cycle markets fail because pricing ignores structure. Post-breakdown markets stabilize because pricing respects structure. This is the key difference. Another important adaptation is behavioral humility. Participants become aware of complexity. They stop assuming control. They accept uncertainty. This reduces aggressive positioning. Another shift is the decline of narrative certainty. Before breakdowns, everyone knows what will happen. After breakdowns, no one does. This uncertainty discourages concentration. Another adaptation is slower capital movement. Flows become cautious. Momentum weakens. Reversals increase. This reduces trend persistence. Another structural change is the reintroduction of asymmetry awareness. Participants recognize downside risk. They hedge, they reduce exposure, This reduces convexity. Another important shift is the recalibration of success. Before breakdowns, success is maximizing return. After breakdowns, success is surviving volatility. This changes incentives. Another adaptation is the reduction of speed. Participants slow down. Decision-making lengthens. Algorithms are adjusted. This reduces whipsaw. Another change occurs in liquidity pricing. Liquidity becomes valuable. It is no longer free. Participants pay for. Immediacy. This improves allocation. Another shift is the decline of extreme narratives. End-of-the-world narratives fade. So do perpetual growth narratives. Moderation returns. Another adaptation is the rebuilding of trust. Trust does not return immediately. It rebuilds slowly. This slows cycles. Another important change is the normalization of volatility. Volatility becomes accepted, not feared, not sold aggressively. This stabilizes markets. Another adaptation is structural diversification. Participants diversify not just assets, but strategies, time horizons, liquidity profiles. This improves resilience. Another shift is the reduction of complexity. Overly complex structures unwind. Simplification occurs. This reduces opacity. Another change is the repricing of optionality. Optionality becomes expensive. Participants value flexibility. This changes positioning. Another adaptation is the alignment of incentives. Late cycle incentives reward risk-taking. Post-breakdown incentives reward prudence. This reshapes behavior. Another important shift is the restoration of discipline. Discipline returns because consequences are remembered. Memory enforces restraint. Over time, memory fades. Cycles restart. But until then, markets behave differently. Post-breakdown markets are not broken. They are recalibrated. They reflect limits. They reflect uncertainty. They reflect realism. This realism is uncomfortable for those expecting easy returns, but it is healthier because it reduces fragility. It allows the system to absorb stress. It rebuilds resilience. This phase does not last forever. Eventually, stability breeds confidence. Confidence breeds risk-taking. Risk-taking breeds fragility. The cycle repeats. But the immediate aftermath of breakdowns is critical. It resets assumptions. It realigns structure and pricing. It restores balance. Understanding this prevents misinterpretation. Markets are not weak because they are calm. They are weak when they are overconfident. Markets are not strong because they are volatile. They are strong when they absorb volatility without disorder. Post-breakdown markets are often stronger than they appear because they respect limits, they price uncertainty, they discourage excess. This is the environment where resilience is rebuilt, quietly, gradually, structurally. Market cycles do not end. They transform. This is the most important misunderstanding in how people think about financial systems. Cycles are often described as linear. Expansion, peak, collapse, recovery. But real cycles are not linear. They are adaptive. Each phase changes the structure of the system. Each adjustment alters incentives. Each breakdown rewrites assumptions. What follows is never a return to the previous state. It is a new configuration built on the memory of what failed. This is why history does not repeat, but it does rhyme. Late cycle environments look similar. Across decades, not because markets forget, but because incentives reassert themselves. Stability encourages risk. Risk builds fragility. Fragility produces adjustment. Adjustment restores discipline. Discipline fades. The cycle restarts. This process is not moral. It is mechanical. Markets do not punish excess because excess is wrong. They adjust because excess is unsustainable. The critical insight is that fragility is not visible in outcomes. It is visible in assumptions. When assumptions narrow, systems become vulnerable. When assumptions widen, systems stabilize. Late cycle markets are defined by narrow assumptions. Assumptions about liquidity, assumptions about correlation, assumptions about policy support, assumptions about continuity. Post-breakdown markets are defined by wider assumptions. Participants no longer assume. They consider. This difference determines behavior. Cycles persist because incentives persist. As stability returns, caution fades. As volatility compresses, leverage returns. As memory weakens, confidence grows. The system slowly rebuilds the conditions that caused the previous adjustment. This is not irrational. It is adaptive behavior responding to current conditions. Markets reward what works. They penalize what does not. When caution underperforms, it is abandoned. When risk-taking outperforms, it is embraced. This feedback loop is unavoidable. What changes from cycle to cycle is not the existence of excess. It is the form it takes. In one cycle, excess concentrates in technology. In another, in housing. In another, in sovereign debt. In another, in volatility, selling, or passive concentration. The asset changes. The structure does not. Every cycle contains a phase where the system believes it has solved risk. That belief is the most dangerous signal, because risk cannot be eliminated. It can only be transformed. When transformed risk becomes invisible, it becomes systemic. Systemic risk does not announce itself. It accumulates quietly. This is why the most dangerous periods do not feel dangerous. They feel efficient. They feel rational. They feel stable. The absence of visible stress is often interpreted as strength. In reality, it can be a sign of optimization without redundancy. Optimized systems perform exceptionally well under expected conditions. They fail rapidly under deviation. Markets spend most of their time optimizing. That is why cycles exist. Another misconception is that cycles are driven by emotion. Fear, greed, panic. Emotion plays a role. But structure matters more. Behavior follows incentives. Incentives shape structure. Structure determines outcomes. Fear does not cause crashes. Constraint does. Greed does not cause bubbles. Distorted incentives do. Emotion reacts to structure. It does not create it. Understanding this reframes how risk should be interpreted. Risk is not volatility. Risk is sensitivity. Sensitivity to funding. Sensitivity to liquidity. Sensitivity to correlation. Sensitivity to assumption failure. Late cycle markets are sensitive. Post-breakdown markets are robust. Robust does not mean profitable. It means resilient. This distinction matters. Many participants chase environments that feel good. Low volatility, smooth returns, clear narratives. These environments often carry the highest hidden risk. Other environments feel uncomfortable, choppy, uncertain, uninspiring. These environments often carry lower systemic risk. Markets reward comfort until they punish it. They punish discomfort until they reward it. This inversion defines cycles. Another important insight is that no authority controls cycles. Policy can influence timing. It can smooth transitions. It can delay adjustments, but it cannot remove them. Attempts to eliminate cycles often amplify them. By suppressing volatility, pressure builds. By delaying adjustment, imbalances accumulate. By protecting downside, leverage expands. When adjustment finally occurs, it is larger. This is not failure of policy. It is limitation of control. Complex systems resist precise management. Markets are complex systems. They respond to interaction, not intention. This is why policy effectiveness diminishes over time. Each intervention changes behavior. Each change alters structure. Each alteration reduces predictability. The more a system is managed, the more adaptive it becomes. Eventually, policy responses that worked before lose effectiveness, not because they are wrong, but because the system has changed. This is another reason cycles persist. Participants adapt to the last solution. The next problem emerges elsewhere. Another misunderstanding is that cycles are synchronized globally. They are not. Different markets reach late cycle conditions at different times. Different systems carry different vulnerabilities. Different constraints bind differently. But global integration spreads stress. When one system adjusts, others feel pressure. This is why cycles increasingly feel global. Interconnection amplifies transmission. Another structural factor is time compression. Modern markets operate faster. Information moves instantly. Positions adjust automatically. This compresses cycles. What once unfolded over years now unfolds over months. But the underlying mechanics are unchanged. Leverage still amplifies. Liquidity still withdraws. Correlation still rises. Assumptions still fail. Speed changes perception, not structure. This is why modern breakdowns feel sudden. They are not sudden. They are revealed quickly. Another important realization is that cycles never end in equilibrium. They end in transition. There is no stable final state, only temporary alignment. Alignment between pricing and structure, between expectations and capacity, between behavior and constraint. Once alignment is achieved, stability emerges. Stability encourages risk. Risk disturbs alignment. The cycle restarts. This is not pessimistic. It is descriptive. Markets exist to allocate capital under uncertainty. Uncertainty cannot be eliminated, only priced. When uncertainty is underpriced, cycles form. When it is overpriced, opportunity emerges. This oscillation defines market behavior. Understanding cycles does not provide prediction. It provides context. Context reduces surprise. It clarifies risk. It shapes expectations. The goal is not to avoid cycles. It is to recognize where within them behavior is being rewarded or punished. Late cycle environments reward exposure. Post-breakdown environments reward patience. Neither lasts forever. Another critical insight is that markets do not collapse when people expect them to. They collapse when positioning assumes continuity. Expectation of collapse often coincides with reduced exposure. That reduces fragility. Expectation of stability coincides with increased exposure. That increases fragility. This inversion explains why fear often appears near bottoms and confidence near tops. Emotion lags structure. Understanding this helps avoid misinterpretation. Markets are not signaling danger when volatility rises. They are signaling danger when volatility is absent, despite rising sensitivity. Cycles are not about timing peaks. They are about recognizing vulnerability. Vulnerability is not collapse. It is exposure to disproportionate reaction. Sensitive systems overreact. Resilient systems absorb. Late cycle markets overreact. Post-breakdown markets absorb. This is why adjustments feel violent at cycle turns. Not because news is shocking, but because structure cannot absorb pressure. Another misconception is that cycles are avoidable through intelligence. They are not. The smartest participants contribute to cycles because they respond rationally to incentives. Intelligence accelerates cycles. It does not prevent them. This is why cycles persist despite experience. Each generation believes it has learned the lesson. Each applies it to the last crisis. The next crisis emerges elsewhere. Learning is always backward-looking. Risk is forward-looking. This mismatch guarantees recurrence. What changes is awareness. Those who understand structure are less surprised. Those who focus on narrative are repeatedly shocked. This is why structural analysis matters. It does not predict outcomes, it clarifies vulnerability. And clarity is the only advantage available in complex systems. Cycles do not require dramatic catalysts. They require alignment failure. Alignment between leverage and liquidity, between pricing and capacity, between confidence and constraint. When alignment fails, adjustment follows, quietly at first, then visibly. This pattern repeats across history, not because markets are flawed, but because they are adaptive. Adaptation ensures survival. It also ensures repetition. The final insight is that cycles are not enemies. They are correction. Mechanisms. They prevent permanent distortion. They reset assumptions. They restore balance. Without cycles, systems would collapse permanently. Cycles are uncomfortable, but they are necessary. The danger is not cycles themselves. It is denial of them. Denial encourages overextension. Acceptance encourages resilience. Markets that accept cycles adapt. Markets that deny cycles break. The same is true for participants. Those who assume continuity are exposed. Those who respect limits are prepared. Preparation does not mean fear. It means awareness. Awareness of how structure shapes outcomes. Awareness of how incentives influence behavior. Awareness of how stability can conceal fragility. This awareness does not eliminate risk. It contextualizes it. And context is the difference between surprise and understanding. Cycles will continue. They will take new forms. They will use new instruments. They will involve new narratives. But their structure will remain familiar. Liquidity will expand and contract. Leverage will build and unwind. Confidence will rise and fade. Each cycle will feel unique. Each will be structurally similar. Markets do not evolve away from cycles. They evolve through them. And that is why understanding structure matters more than predicting events. Because events change, structure persists. This is the quiet truth of market cycles. Not dramatic, not predictive, but structural.